Good morning, everyone. I think we're ready to get started now. Welcome to the Tensoft-sponsored executive webcast today, FASB IASB Exposure Draft, Revenue from Contracts with Customers. Our presenter today will be Jeffrey Werner, and I'm Caprice Murray from Tensoft. Just a few things about the event this morning, a few viewing tips and CP credit information before we get started, and then we'll be telling you a little bit about today's webcast sponsor, Tensoft, and then an introduction to today's speaker, Jeffrey Werner, and then we'll get right into the presentation and on to a Q&A period. If you could please put your screen on full screen. We recommend that for viewing. Go to View on the control panel to the right. And if you have any questions at any time, please go ahead and enter them into the Q&A panel on the right. We'll answer them at the end of the webinar. Also, CPE certificates. Tensoft is a NASBA registered CPE sponsor. We'll be emailing these to everyone who is eligible within 1 week of the event. If you attend the whole event and you answer the polling questions, we will be sending those to you. Also, the slides will be available to download after the presentation from Tensoft's Resource Center. Just go to www.tensoft.com, go to the Resource Center, register real quickly, and you'll have access to those. Also, you, again, may submit your questions anytime via the Q&A panel to the right. After the webcast, you can submit questions, email them to Jeffrey or to myself, and we'll get those answered for you if there's anything that we don't have time for during the session today, or if something comes up later. Please feel free to get in contact with us. We'll also be posting questions and answers to the Tensoft blog after the event, so be sure to check in there for that information. And again, slides will be available for download after the presentation on the Tensoft Resource Center. And now I'd like to introduce Tensoft CEO Bob Scarborough, who will be introducing Tensoft to you today. Bob, go ahead and take the floor, please.
Thanks, Caprice, and welcome everybody. And so we want to briefly cover Tensoft and why we're interested in revenue management and pleased to sponsor today's event. And so a few quick things on who is Tensoft. We are a software provider. We focus on technology companies. And specifically important for this, related to this discussion, is we have software to support revenue management, and revenue management both from a compliance perspective for current standards like SOP 97.2, EITF 0801, but also for just the complexities of revenue recognition and deferrals management and subledgers and really the complete set of functionality required. There's a revenue management suite, a billing management. We support specific business models and transaction flow. Next slide, please. And a little bit more about us that's helpful in terms of questions people usually ask. We're located pretty much where technology companies are, and so a lot of that tends to be across U.S., Europe, and Asia. We have pre-revenue to significant public companies using our software. And we're really familiar with the growth cycle of technology companies, the ability to rapidly ramp and scale. And really, we do seek to partner with companies to help them meet their needs and to scale with them as they grow. We're located in Silicon Valley. But we do have operations in Europe and Asia to provide the usual expected levels of support and local presence and as well as on-the-ground marketing and sales support. In terms of the industry knowledge, probably the best things to focus on there, 150 plus technology industry customers, and really that we focus on deep industry knowledge rather than broad general knowledge. And so we really look to be able to partner with your organization to understand your needs before we start an engagement to really bring value to you right up front. Next slide, please. So for our revenue management, which I think just a couple of slides on this, and then we'll move on to the core presentation today. The revenue management for us is transaction-based, or you could call it agreement or contract, whatever it is, and so we do look to generate the transaction or capture the transaction based on your go-to-market model, and that could be from your website, from your business software system, from our contract administration system, from a variety of ways. We have this. Sometimes in the current U.S. GAAP, it would be a multi-element arrangement captured, or a contract, or whatever it is that captures the whole of the agreement with the customer. And for the revenue basis, we look at different workflows based on different types. We do have customers that have more than one revenue recognition method that they need to, for GAAP compliance, that they need to consider. And so we are looking at, transaction-based, and as previously mentioned, we are fully supporting the 97.2, the 0801, and some of the other revenue methods as well in terms of complexities related to delivery and revenue recognition methods. Next slide, please. I think this is maybe the easiest way to see it, and if we start from the left moving to the right, this is really how we're handling the multiple transaction flows, the results of your go-to-market model, how you sell. And so we have these transactions generated, again, from your website or your CRM, or from our contract administration or your ERP system. The transaction is captured as the full multi-element arrangement and then moved into our revenue base, our revenue methodology. And in that place, we apply rules to it. We apply the value determination or the fair value reallocation. We handle the multiple document flows to handle different revenue recognition rules. And so really we're capturing the transaction, we're applying a rules-based approach, and that is updating your subledger, which will post your revenue to your ERP, update all of your reporting and analytics, including the ability to forecast, the ability to drill down into specific information. So next slide, please. So Tensoft is committed to providing revenue recognition, contract management software solutions to our customers, but we understand this software is only part of the total solution. Another element in managing revenue recognition and contracts is understanding the rules and standards that affect your business. With that in mind, we work with thought leaders in this area to provide relevant information and resources to our customers and interested companies. So we're pleased to have the opportunity to sponsor today's online course taught by software revenue recognition expert Jeffrey Werner. Jeffrey is an acknowledged expert in the area of software revenue recognition. He's been providing revenue recognition consulting services to software and technology companies since 2001. Prior to launching his consulting business, Jeffrey was the CFO of Atrium Design Systems, a mixed signal synthesis company in Silicon Valley. Before that, he was VP of Finance at Telepost, a web-based communication services company based in Santa Cruz. Early in his career, he spent 11 years with KPMG. And basically, Jeffrey has done this from an end-user perspective. He's done this from a consulting perspective. And today, he has a broad knowledge from multiple engagements and multiple experiences in multiple companies on what really are the requirements to recognize revenue, both how it can best help your company as well as how it can, what the compliance with the GAAP standards are. He regularly teaches software revenue recognition classes in the San Francisco Bay Area. Over 15 years experience helping companies comply with revenue recognition regulations and policies and best practices. So Jeffrey, over to you.
All right, thank you very much for the introduction, Bob, and welcome everyone to our webcast today. Today's topic will be, or is, the new FASB IASB exposure draft on revenue from contracts with customers. Again, a couple things. If you tuned in late, there will be polling questions, so if you want to get CPE credit for attending today's webcast, please answer the polling questions, and those CPE certificates will be sent out sometime next week. If you have a question during the course of the webcast, you're welcome to use the question function over on the right side of your screen and type that question in for us. We'll try to answer questions as they come up when they're on topic or towards the end of the webcast to the extent that we have time to address them. This is one of a series of webcasts we've been doing 3 or 4 times a year, 1-hour free webcasts on various revenue recognition topics. Today's topic is a future-looking topic about the new process that the FASB and the IASB are proposing for revenue recognition. It is, as I say, new, and it's not something that's in place and in practice right now, so a lot of what we'll be talking about today is theoretical and things that companies and revenue recognition practitioners have not had really an opportunity to actually practice. But we'll be going over a number of topics regarding the exposure draft. And here's our agenda for today. First, we'll take a look at an overview of the who, what, when, where, why we have this this exposure draft. We'll look at the process that generated it and the scope of what it covers. We'll look at an outline of what the actual exposure draft is and the various sections and what they cover. We'll take a look at the 5 new principles of revenue recognition that are present in the exposure draft. Then we'll take a look for a number of instances of what are the differences in this new model from the current U.S. GAAP, talk about some of the implementation guidance that's in the exposure draft and that auditors and consultants are recommending companies consider, and look at some of the effects, the changes that these new proposed revenue recognition methodologies will have for technology companies. So that's our outline for today. Before we go into the first step, the overview, let's do our first polling question. And if you can answer that polling question, then you'll be able to be eligible for CPE credit. Now, do I need to do something here? So our first question is, how did you find out about the webcast? Did you get a Tensoft email? Did you see something in LinkedIn? A friend alert you to it, or just happened into it on a web search? So our polls are open. You can answer one of those questions, or one of the answers to that question, and then we'll be moving forward with the rest of the content of the webcast today. And is that how the voting is doing? Okay, so we need a few minutes on this to let everyone know. Looks like there's over 100 people attending the webcast today from a variety of locations around the U.S. and the world, so welcome to all of you. Let's move forward now with our first topic. So this is the overview of the exposure draft. So it's the who, what, when, where, or why. Who's issuing this exposure draft? Well, the unique thing about this accounting literature or pronouncement that's coming out, it is a joint issuance from both the FASB, which is the Financial Accounting Standards Board, the U.S. body that governs accounting rules, and the IASB, the International Accounting Standards Board, which issues accounting rules for companies worldwide. And one of the unique things is that when this is issued, since it's issued by both the FASB and the IASB, it will be part of U.S. GAAP when it's final. It will also be part of IFRS, our International Financial Reporting Standards. One thing that there has been some confusion about is when this is issued, it will be U.S. GAAP regardless of whether the United States converts to IFRS in general. So it will be required accounting when it becomes effective. What is this exposure draft? Well, it's a 217-page set of proposed accounting standards for revenue recognition, and we'll go through the various parts of the outline of the exposure draft. So it's a fairly significant document. Doesn't really, I guess when you compare it to the hundreds or thousands of pages that are current U.S. GAAP with regards to revenue recognition, even with the recent codification that kind of organized them and set them together, it's a smaller document, but it's going to have real big ramifications for how we do revenue recognition. Currently, it's in the second round of review for comments, and I believe the comment period closes today. I think the way the website's said it was comment period closes on the 13th. I'm not sure if that meant midnight last night or midnight tonight. So if you after the webcast today you have some opinions about something in here and you would like to send a comment letter to the FASB, I think you still might have time to do that. If you'd like to get a look at the entire document, the FASB website at fasb.org has the exposure draft there, so you can download it. And there is a slight difference between the FASB and the IASB exposure draft. The IASB uses Anglican in English, so there's S's instead of Z's, and some of the wording is different, and the references to existing literature is a reference to the IASB or IFRS literature. The FASB one references current U.S. GAAP. But other than that, the two documents are essentially identical. Also at the FASB website, there's a podcast you can listen to, there's a webcast, and there's a schedule of roundtable discussions that they're having across the U.S. during the rest of the year that are meetings that you can actually go to. And I believe they often webcast or podcast those as well. So there's more information about that at fasb.org. When is this exposure draft going to be GAAP? It's planned to be finalized sometime in 2012. So the process is after the comment period closes today, the FASB will read those comments, review them, and decide whether they need to make any changes to the exposure draft. And then they plan to issue the final revenue recognition rules for revenue from contracts with customers later in 2012. My guess it would be sometime in the November-December timeframe. And the effective date is planned to be no earlier than 2015. This is one of the many controversial aspects of this proposal because if you're a public company, you need to present 3 years of financial statements using the same accounting methodology. So if it becomes effective in 2015, starting in 2013, you'd have to have 2013 and 2014 available to be presented in the new methodology when you present your financial statements in 2015. For public company or private companies that only present 2 years, you'd have to essentially start in 2014 if it becomes effective in 2015. So when this becomes final will be very important to stay on top of, and it could be as early as 2015, probably 2016, given the way things have been moving rather slowly on this. Where will this proposal be effective? Well, it'll be required accounting when adopted in the United States under U.S. GAAP, which is issued by the FASB, and in any country that follows IFRS, which is currently more than 113 countries worldwide. So it will be the accounting for the U.S. Technology companies. Why is this happening? This is a great question. A lot of people think that even though revenue recognition has been difficult, it's not completely broken. But this initiative is part of an ongoing process to align or harmonize accounting worldwide so that, in theory, all companies worldwide are using the same accounting system. It's also an attempt to have one comprehensive revenue recognition approach for all customer contracts. Currently, we have lots of different rules for lots of different industries, and even with the codification of U.S. GAAP, there's many places where you can encounter the revenue recognition rules that may affect your company. The plan is to try and remove current inconsistencies in revenue where different companies report the same revenue transactions differently, thereby improving comparisons between companies, and also to enhance disclosures and provide more information and transparency about the company's revenue results. And one of the goals is to simplify accounting and guidance, although I think our experience is whenever new pronouncements come out even with the best of intentions to simplify, things tend to get more complicated. And I think we'll see that happening as we go through some of the changes that will be present when this becomes accounting guidance. The process has been years of discussions, part of this grand concept to harmonize the world of accounting worldwide. The first exposure draft came out in June of 2010. Comment period closed in October of 2010. There were so many comments that they took a whole year to redraft the exposure draft, responding to those comments, and they issued a new exposure draft in November. And as I indicated earlier, the second comment period closes today. The plan is to issue the final standard this year and have it be effective at the earliest in 2015, hopefully 2016. The scope, what this exposure draft covers and what the rules will be about, is all contracts with customers, the revenue recognition for them. And the only exceptions that are in there currently will be for leases, insurance, and excuse me, some financial instruments. The big controversial aspect of it is they are holding firm with this retrospective adoption, which means you have to have all the years that you present in your financial statements under the same methodology. So if it's 2015, public companies 2013, 2014, private companies 2014 and 2015. Here's an outline of the exposure drafts of these 217 pages. First, there's a 10-page summary which gives a high-level view of what the exposure draft covers. Then there's 40 pages of proposed guidance and implementation guidance and examples. And then there's about 100 pages of background information, basis for the conclusions, why did they do things the way they did, some explanation of their rationale, and maybe some examples of alternatives that they considered and did not adopt. And then there's some additional appendices and other information at the end of the outline. So that's the basic outline of the exposure draft. In the summary, these are the topics that are covered. And the first one we'll spend significant time with this morning is the 5 steps to revenue recognition. Also, it talks about when the amount of revenue is going to have some kind of limitation or constraint, as they call it. What are the treatment of lost contracts, or in the language of the exposure draft, onerous performance obligations. How we deal with contract costs, both pre-contract costs and post-contract costs. What the new required disclosures will be, and then the effective date, which we've discussed. And in the exposure draft, they actually posed a number of questions that they said, companies that review this and respond to it, could you please address these questions? The implementation guidance expands and looks at a number of topics and provides some initial guidance for them, things like sales with rights of return, how to address warranties, when you do gross versus net as far as who's a principal and who's an agent in a revenue transaction, how you address options for purchases of additional goods or services, what if the customer has unexercised rights, non-refundable upfront fees, how you deal with those, licensing rights and use, repurchase agreements, consignment arrangements, bill and hold, and customer acceptance. All of these are topics in that implementation guidance section. And then, as I mentioned, there's this additional section with some background information, why they chose the approaches that they've chosen to a certain extent, and why they didn't choose some other proposals that people had made or that were responses in the comment letter. How are we doing on questions? Pravis, do we have any that we need to address now? Or? Okay, so we'll keep going. Let's take a look at the current revenue model that we're following under U.S. GAAP and compare that to the revenue model that's in the exposure draft proposal. So in our current revenue recognition process, there's 4 principles of revenue recognition that we have to meet in order to recognize revenue. We have evidence of an arrangement, so we need a contract or some agreement with a customer. The fee needs to be fixed and determinable, So it's a set amount, and we know we're going to recognize that amount, and if there's any amounts that are contingent or either increases for contingencies like performance bonuses or decreases for things like penalties, we net those out and only recognize the fixed and determinable fee. Then we have delivery, that we need to deliver or perform the services. And finally, our fourth revenue recognition criteria is collectability. The revenue or the cash, the consideration from the transaction needs to be collectible in order for us to recognize revenue. Here's the new model that's proposed under the exposure draft. First, there's a core principle. And everything else in the exposure draft tries to amplify or explain how we meet the criteria of this core principle. The core principle is recognize revenue to depict the transfer of goods and services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those services. So the core principle is you recognize revenue when you've performed or delivered the good or service that you're selling, and you recognize the amount that you expect to receive from that. That's different from the way we're currently recognizing revenue. And to apply this core principle, there's 5 steps that the new model presents. So again, just to contrast the two, our current revenue model has both the residual method for software companies, which is the legacy method for all companies, or for most companies, and the relative selling price method, which was introduced 2 years ago with the EITF 08-1. And then there's a host of other industry-specific methods for various industries, various businesses, things like coal and gas, entertainment, financial industry, lots of different methods for different companies. In the new model, as we said, all companies will follow this except those 3 that got excluded from the scope of this, and the relative selling price method will be the only method used, the relative value method, I think it's called. There'll be allocation based on the relative value, and as the relative selling price method implies, the discount's going to go to all elements within a transaction. Let's look at the 5 steps to revenue recognition that the new exposure draft is introducing. We'll talk about what the 5 are, and then before we go into them, we'll have our second polling question. So the first step is to identify the contract with the customer. This is similar to our evidence of arrangement current requirement. Then there's a step to identify each performance obligation that is in that contract. Determine the transaction price. How much are we going to recognize revenue for this transaction? Our 4th step is allocation of that transaction price to each one of the obligations that we identified in step 2. And those obligations are very similar to what we call elements in a multiple element arrangement currently, so just a slightly different vocabulary. And then finally, the 5th step is to recognize revenue on the satisfaction of the performance obligation. So when it's delivered or performed, we recognize the revenue. Before we go into the individual steps within each one of these steps, let's have our second polling question. And the question is, has your company reviewed the impact of the FASB IASB revenue recognition project? So yes, your company's reviewed that. No, you haven't, or NA, you don't think it's going to apply to you. And the polls are open, so you can answer that question. Do we have any other specific questions that have come in? So we haven't had any questions so far, but if you do have a question that you'd like to ask, you're welcome to use that question and answer box on the right side of your screen and type in your question. It'll pop up here, and we'll try to answer that. Again, if you'd like to receive CPE credit for today's webcast, you need to answer the polling questions and be logged in for the entire webcast. Okay, and it looks like most of people have not really reviewed the impact of the FASB IASB exposure draft, so maybe this introduction today is going to be of benefit to you. let's look at the 5 steps in a little more detail. So identify the contract with the customer. A contract has to have commercial substance. Parties need to have approved the contract, and this is we'll talk a little bit more about this, but this is kind of a different step than we have with evidence of arrangement, because there isn't a strict requirement that the contract be signed. If it has been approved and signatures are a formality, maybe that's not required for a transaction to be a contract with a customer. There have to be identifiable rights and obligations on either goods or services in the contract, and payments have to be specified. They have to be identifiable. In addition, we will need to look at the concept of combination of contracts, which is very similar to our old TPA 39 linked contract criteria, where we look at the time that contracts are entered into, whether there's related elements. And then finally, in this identifying the contract with the customer, identifying if there are any contract modifications that subsequently occur that need to become part of this contract and change the accounting for the contract. Our second step is to identify the separate performance obligations. So this is similar to the elements of a multiple element arrangement. Do we have elements, or do we have one transaction? We need to identify distinct goods and services, so that instead of saying standalone value or an element of the transaction, the vocabulary now is a distinct good or service. It's distinct if it's sold separately. That's similar to our current criteria. It's distinct if the customer can benefit from it independently. So again, if it has standalone value, or if it can be combined with other resources the customer has or can obtain to provide value to the customer. And if it doesn't meet that criteria, if it's not distinct, then we would treat it as one obligation. We would also treat it as one obligation if there are multiple obligations that are performed together or at the same time. For convenience, we can just treat them as one performance obligation or one element in the transaction. Our third step is to identify or to determine the transaction price. And this is an area where there's going to be significant divergence from current U.S. GAAP, and we'll look at some of the details of that when we do a slide that compares the current method with the proposed method. The amount that we're going to recognize for a transaction is the amount that the vendor expects to be entitled to. This is a more subjective criteria than our current fixed and determinable arrangement. And there's some new factors that we're going to consider in determining the transaction price that we typically haven't utilized. So one of them is variable consideration. So if the amount of the fee isn't fixed and there are variables that will cause that fee to go up or go down, that variable consideration will be estimated and included in the transaction price, whereas currently we would exclude that. Another item that will be included that currently is not generally included in determining the transaction price or the fixed and determinable fee is the time value of money. We'll talk more about most of these a little later. And then there's how to account for non-cash consideration, things that are trade or services that go back and forth between the customer and the vendor. And finally, how to account for considerations that are payable to a customer. So if we have a transaction both with the customer as a vendor and with our customer as a customer of theirs, how do we account for those? Typically, under current U.S. GAAP, you'd see that you're more often than not going to net those unless you have fair value and meet some other criteria. Here that's been expanded, and there are probably going to be more cases where if you've got transactions both way with a customer, you can recognize both those as revenue and as expenses rather than netting them as we currently do. Our fourth step in the five-step process is to allocate the transaction price to the obligations. So typically we're going to determine the standalone value of each element in the arrangement or each obligation in the new vocabulary, and then we're going to allocate the revenue to them based on the relative value of each item. So this is very similar to the process that we do under 08-1 ASC 605 using the relative selling price method. There are some differences, though. We're going to estimate standalone selling price, but if it's not, and the method that we're going to use that is the adjusted market approach. So if we don't have a standalone selling price, I guess sort of similar to our current VSOE concept, we use what is called an adjusted market assessment approach. So a variety of factors would be included to determine what would be the fair value of this in the marketplace, comparisons to other vendors, comparisons to prior pricing, expected pricing, the same sort of things that go into estimated selling price under our current method. And the expected cost plus margin, which is one of the methodologies that we use to estimate the selling price under 08-1. A unique feature that's been added, though, is if those types of estimates aren't readily available, you may be able to apply the residual approach. And the criteria was if the obligation is highly variable or the price for it is uncertain, you may be able to adopt a residual method approach where if you've got 3 elements and you know the value of 2, you subtract to get the third. This is just for the allocation. However, if you've got 4 and you don't have 2, it becomes more complicated. I think the residual approach only works if you have 1 element. And again, this is just for the allocation. We're going to allocate, as we indicated, the revenue to each obligation or element based on the relative value. And some discounts or contingent revenue that may relate to a specific contract obligation may be applied to that specific contract obligation. Unlike the revenue relative selling price method under 08-1, where all the discounts are allocated to all of the elements, here, if there's contingent revenue or discounts that are directly tied to a specific contract obligation, then those may go only to that obligation or elements. And then something we don't encounter very often under current GAAP is if there's going to be changes in the contract price or if changes occur, you're going to allocate them to allocate those changes in the same method that you used to allocate the revenue originally. So for example, if you thought the expected value of the contract from a transaction was $100 and you recognize that, but later it turned out to be only $90, that $10 difference would be subtracted from revenue of the obligations using the same method that you allocated the revenue to them. So if you allocated 60% to one element and 60% to another, and you had this adjustment either up or down, you'd use that same percentage to allocate the revenue adjustment to those obligations, both obligations that you've recognized the revenue for and revenue that you had deferred and is pending revenue recognition. And then finally, you'd recognize revenue on the satisfaction of the performance obligation. Each performance obligation, as it's satisfied, you'd recognize the revenue for it on one of 2 ways, either over a period of time or a point in time. And recognition of a performance obligation has an additional concept that addresses when control is transferred to a customer. So that's the criteria to determine whether you've met the performance obligation. And there's a lot of questions about how that transfer of control will be addressed. A lot of people commented on that in the process because of the way we currently do percentage of completion accounting, where we recognize revenue on a percentage basis over the progress of a contract. If that item that's being performed isn't transferred to the customer, there's a question of whether we meet this criteria here for satisfying the obligation by transferring control of the good or service to the customer. So there's some criteria that helps us determine when control is transferred to the customer. If an asset is created or enhanced and the customer controls the asset, so one way they would control it to have physical possession of it. If no asset is created but the customer receives and consumes the benefits of the service, then we're saying that the control has been transferred to the customer. And if another entity wouldn't have to reperform that work, that would be another indication that the control has been transferred to the customer. And then finally, we also need to have a right to the payment for the performance that has been completed. So if we only did partial performance and we're trying to recognize partial revenue, we have to have right to the payment for that. It couldn't be dependent upon completion of the contract or a payment in the future to recognize the revenue. The criteria for when control is transferred to the customer at this point in time is similar to our delivery requirements. It's when the customer has legal title to the asset and the vendor has the right to the payment for it. So, for example, the customer needs to accept the asset before it takes title to it and before the vendor has the right to payment. If it's a physical item, the vendor's transferred physical possession to the customer, and the customer has the significant risks and rewards of ownership of the asset. This is fairly consistent with our current approach for delivery criteria. So what's different from US GAAP? Well, we got 2 slides here with a number of items that are different from US GAAP, and we're going to go through some kind of before and after slides to cover those, to help compare and contrast the 2 methods. So here's one of the list, and here's the second. Then we're going to move through the list fairly quickly because we're going to cover these in detail. So our current methodology for evidence of arrangement is that we have persuasive evidence. We've got signed written contracts. In the new revenue model, a contract exists when there's an oral, written, or implied contract that has commercial substance and has been approved by the parties. It has identifiable rights and identifiable payments, which is different from, our current requirement that contracts be signed, for example. Delivery. What are the differences between delivery and performance? Well, substantive performance, the pass of risks and rewards to the customer, acceptance, point in time versus overtime, and then the multiple element rules that we currently have. We talked about performance would be when the goods or services are transferred to the customer under the new model, and that includes the vendor has a right to the payment, legal titles passed to the customer, physical possession is passed along with the rights and rewards, and the customer is accepted. So delivery on a point in time is pretty similar. Here's a big difference between the 2 methodologies and how they address collectability. Under our current model, an item must be collectible in order to be recognized. And if it's not collectible, we're going to defer it and recognize on the cash basis. In the new model, there's no concept of collectibility. There's a concept of credit risk. So we're not going to defer for collectibility issues. We're going to recognize the amount that the vendor is expected to be entitled to, the net amount. So if we have normally a 3% bad debt expense, we're going to recognize 97% of revenue. If an item is significantly in doubt whether we're going to collect from the customer, the position of the new model is, well, maybe a contract really doesn't exist because one of our requirements for a contract was that payment be assured. And then impairment is going to be presented as an item in revenue, not as bad debt expense down in general and administrative expenses in our statement of operations or income statement. So let's go to our next polling question. So this is question number 3 out of 4. And we're about 2/3 of the way through the webcast today. So our question is, what is the level of activity at your company on the exposure draft? Are you planning to implement? Have you read and sent a comment letter? You kind of know about it. You're attending today to find out more about it. or you've done nothing to date. So that's our polling question. And while we're doing that, let's look at some of the questions that have come in. What does it mean by commercial substance? I think there has to be, I'm not sure that there's a paragraph that defines that, but there has to be some business reason for the transaction. For example, 10, 12 years ago, there were a lot of .com companies that had these swap type of transactions that didn't have any, I would say, commercial substance. I'll give you some of mine, you give me some of yours. We'll both recognize revenue and expense. I don't think those have commercial substance. There has to be some business reason for the transaction, some benefit to the customer, and some consideration to the vendor. And let's see, does physical possession mean delivery acknowledgement at customer location? I think we would still have our criteria that are similar to FOB shipping and FOB destination. So that would depend on the contract terms and the shipping terms. So physical possession wouldn't transfer to the customer from the vendor on an FOB destination until it was received by the customer. But if the contract and legal terms were that it is an FOB shipping model where the customer is considered to have the rights and risks of the physical transfer of goods at the point of departure from the vendor, then that would be the point of transfer. And so we got a variety of responses. The most common one is to know about it today, know about it, and attending today to find out more about it. We have another question we want to address? Okay. So those are the differences we talked about between collectability and credit risk. Fixed and determinable amount, we mentioned this before. Currently, we only recognize fixed and determinable amounts. Any contingent revenue is deferred for potential reductions or increases. We recognize those when they occurred, both the increases and the reductions. Under this new model, we're going to recognize the expected amount, recognize the estimated amount. That would be the expected value or the most likely value. So if there's variable revenue, we're going to estimate that. And there may be adjustments in future periods, both up and down, depending on how good our estimates were. So this is a very different concept. Currently we say we recognize only the certain amount, the net amount. We'd be recognizing variable amounts that haven't actually occurred yet based on what we expect to receive. Our current model has a concept of multiple elements: standalone value, right of return. It's a standalone element when it's sold separately. And in software, we have this concept of VSOE, which impacts our multiple element arrangements. In the new model, we've got distinct goods or services when they're sold separately or when the customer can benefit from that obligation or element. When do we defer revenue? Well, in our current model, if it's not fixed and determinable, we're going to defer the revenue, and we're not going to recognize contingent revenue. In some transactions like software, we defer if we don't have VSOE for undelivered elements. Under the new model, there's this constraint on revenue concept. How much revenue to recognize? Again, estimating if there's variable revenue, taking the amount that's, quote, reasonably assured, and if it's reasonably assured, if we have relevant, predictive experience with similar items so that we can make those estimates. And then we adjust the estimates in the future periods. And I got a question that said, so does that mean we don't have deferred revenue under the new revenue recognition model? No, we would still have revenue that's deferred, for example, until performance has occurred, or if performance is taking place over time, you defer the entire amount and then recognize incrementally that revenue over the course of the contract period. Revenue over time, generally we do that straight line unless there's a different pattern. We have the proportional performance method and the percentage of completion methods. If we have reasonable, dependable estimates and we've got a right to payment. Under the new model, control can be transferred to the customer over time if the customer asset's not going to have any alternative use, and the customer benefits as the performance occurs, and another entity won't have to reperform it. Otherwise, if it doesn't meet those criteria, it'll be recognized at a point in time. So there may be situations that we currently account for under US GAAP as a percentage of completion that under the new methodology would not meet these transfer of control criteria and would be recognized at a point in time instead of over time. Our point in time criteria are pretty similar. Deliveries complete in our current model. The customer's accepted. We've transferred the rights and responsibilities. Under the new model, the vendor's got a right to the payment. Customer has legal title and physical possession and the rights and rewards and has accepted. So those are a little more consistent and similar than our criteria for revenue recognized over a period of time. Contract modifications. In our current model, we typically account for those modifications on a go-forward basis. And we consider there to be concessions if additional goods and services are added to a contract without additional consideration. And estimates and contingent amounts are recognized when they occur. Under the proposed model, if there's a modification in contract, such as a change in the price after inception, we're going to adjust that price in the same method as we allocated the original price. We'll consider contract modifications different from new contracts, and new contracts would occur if we've got new goods and services that are distinct and are consistent with their standalone selling prices, such that there's not a bargain element to that. How do we determine the value of elements or obligations under the new terminology? Well, in US GAAP, we use VSOE, TPE, and ESP, and we've got a requirement for VSOE in our software transactions. In the exposure draft, we're going to determine the value of obligations based on this adjusted market assessment approach, our cost plus margin approach, and perhaps even use the residual method if the obligation or element is highly variable or uncertain. And we're going to recognize revenue or allocate the revenue based on the relative selling price method, the residual method for software companies, and other specific industry methodologies. Under the new method, this relative standalone selling price method will be the method that we allocate and recognize revenue. Our current model addresses things like intellectual property licenses, software. The term of the license needs to begin to start revenue recognition. There's a host of different recognition methods for different industries. We recognize things both over a point in time, or rather over time and at a point in time. Under the new model, they call it license and right to use. You're still going to have the license period begin, but you're going to recognize it at a point in time unless it's fee-based or there's some other constraint on the amount that is reasonably assured to be collected, and the right to use is combined with other obligations. In other words, it's not a distinct obligation. So, for example, in a lot of software transactions, sometimes we recognize those over time, but if that license is a distinct obligation or a separate element, it'd be recognized at a point in time rather than over time. Contract costs. Under the new methodology, we're going to recognize assets for incremental costs to obtain a contract if they're recoverable. We're going to capitalize costs and recognize them consistent with the related revenue. And our current methodology depends on the transaction and the specific industry. Typically, incremental direct costs incurred related to the acquisition are either capitalized or expensed. One area that there's going to be a lot expansion is the area of disclosures. So currently there's the general requirements. We say we meet the 4 criteria of RevRec, and we talk about our specific requirements like how do we handle multiple element arrangements, bill and hold things, and any specific industry requirements. Under the new revenue recognition model, we're going to have to describe what is a contract with a customer, all of the significant judgments and estimates that went into determining the transaction fee, any changes that occurred between our significant estimates or judgments, what assets were recognized from the costs, and then there's a new introduction, which is a fairly significant disclosure, which is a reconciliation of revenue balances. So we've got a slide on that. We're going to have a reconciliation that says of the total revenue that is recognized in this period, how much came from satisfaction of performance obligations, how much came from adjustments, what was the cash that was received, what's the change in AR, were there any non-cash considerations, any effects of business combinations, and additional lines necessary to understand the changes in contract assets and revenue recognized. So this will be a significant new disclosure with a lot of required information to be presented to the customer or presented to the reader that hasn't previously been required. And another significant factor is time value of money. Generally, we don't consider that to be an element of a transaction. Under the new model, you're going to consider time value of money if there's a significant financing component to the arrangement. And that's really described as if the payments are greater than 1 year, you're going to have to consider time value of money. If the time between delivery or transfer and the payment is 1 year or less, then you could exclude that consideration of time value of money from your calculation of revenue. So let's look at our final polling question and also see if any other questions have come in. Can your current accounting systems process relative value allocation of revenues, the type of revenue recognition that's proposed under this new standard and also under EITF? So the polls are open for that. Yes, we hope so. No, don't know. Will setup fees and implementation fees still need to be deferred and spread over the contract term? Well, that would require an assessment of whether those setup and implementation fees are distinct elements that are independent from the other elements, or whether they are really part of one element. So I would say for the most part for SaaS arrangements, I don't think that would change to the extent that you have setup fees in association with a annual usage fee. You probably wouldn't be able to make that separation and say the setup fees meet that distinct criteria in that they have standalone value, because typically they don't have value outside of the SaaS service. But there may be implementation fees, for example, in software or equipment setup, that can be considered distinct and separate obligations and therefore would be recognized in a different pattern than we're currently recognizing them. So that's a very good question. So what are these changes going to, how are they going to affect companies? Well, the significant one on the top of the list is retrospective adoption. In 2015 or 2016, when this becomes required accounting, you're going to have 1 or 2 prior years presented in the same accounting methodology. My experience is most companies have a difficult enough time calculating their revenue under one methodology, and so this is going to be a significant consideration for companies. There's going to be one method for all of your contracts. You're going to have to determine whether your accounting and your ERP system can handle this new methodology, and things like variable and contingent revenue and making adjustments, how you're going to capture your estimates. You're going to need new revenue recognition policies and processes and the associated SOX controls to go with them, because you're going to be doing things under a different methodology, particularly when you've got these estimates that are more of a significant component of revenue recognition than they are now. You're going to have policies and procedures and processes for those. Best practices are going to develop over time. We don't know exactly how they're going to be. And we also don't know how auditors and regulatory agencies are going to view these practices as they develop. In general, it's going to result in an acceleration of revenue. There'll be more flexibility on use of estimates, and there'll be more estimates instead of concrete or objective values. And again, like 08-1, you're going to need to have estimates for all the elements or distinct obligations in your contracts. We talked a little bit about the transfer of control issues. There may be instances where companies are recognizing revenue on a percentage of completion method or over time revenue recognition that won't meet this transfer of control criteria, and so would be recognized at a point in time, most likely at the end of the contract. Some of the other changes, software companies are going to join the rest of the companies using the relative selling price method, so they're going to have values for all of their licenses and elements that they sell, where currently we only need to have VSOE for the undelivered elements. Software PCS may be considered two separate elements, the technical support and the upgrades and updates might impact software companies. Software companies may have this option to use the residual method that we talked about for the determination of the allocation of revenue, but you're only going to be able to use the residual method probably for one item or a group of items that are delivered in the same time, so I wouldn't count on falling back to the residual method. You're going to need a new revenue recognition policy and model and the processes and procedures. We talked about that. And there's going to be new disclosures that we're going to have to make. All of the estimates that we're including in our financial statements, how we determine standalone value and distinct obligations, and this revenue recognition reconciliation that I spoke of. So we're just about out of time, but for your takeaway slide, what are you going to need to consider? Well, remember, these new rules are going to be independent from the adoption of IFRS in the United States. They're going to be US GAAP when this exposure draft is finalized. The retrospective adoption is going to be a big deal for you. You're going to need 2 or 3 years of comparable information in the first year of presentation. You really need to take a look at your accounting systems because you're going to need to be able to do both ways during the transition years or go back and restate. And changing or upgrading your accounting system may not be a trivial exercise. It may take you 18 months or 2 years to scope, procure, and implement. So remember, your current systems may not be able to address all the considerations in the new method, so you really want to be planning ahead. That's our content for today. Thanks really a lot for joining us. I hope this has been a useful introduction to some of the concepts in the exposure draft. If you got any questions, you're welcome to contact me. The email address is there, or you can contact Caprice Murray here at Tensoft. Do we have one more polling question? Or did we get all 4? We got all 4 of the questions, so if you did answer the questions and were tuned in for the entire webcast, you could look for a CPE certificate in your email inbox sometime next week. Please give us time to do it because, as I said, we've got over 100 people on the webcast today, and it does take us a while to do that. Also, if you have other topics that you'd like to see us cover in future webcasts, we've talked about EITF 08-1 before, software revenue recognition, we've talked about SaaS accounting, now we've talked about the exposure draft. If there's other revenue recognition topics you'd like to see us cover or revisit, we'd love to know about that because we will be planning future webcasts. If you want to get the slides, they should be available at the Resource Center at the Tensoft Webcast website sometime later today. Again, if you've got questions, you're welcome to email me. There is a recording being made of this webcast today. Should be posted sometime next week if you want to re-attend or you had drop out or joined late or you know somebody who'd like to listen to it and view the slides. You're welcome to come to the Resource Center next week, and that should be available. And then we'll probably be reprising our software revenue recognition class in May. We've presented this 2 or 3 times now, which is a 2 half-day session on software revenue recognition. So look for that coming up. Again, thank you very much for joining us today. If you've got any questions, please feel free to email them in. And do we have anything else? that we need to cover, or any other questions that we haven't addressed so far? Well, then we'll say thank you very much for joining us, and that concludes our webcast today.